Did you know that the government collected 46% of its revenues from personal income taxes? That is the tax you and I pay. A 2022 study published by the Fraser Institute found that the average Canadian family paid about 45% of its income in taxes. That's more than it spent on essentials such as food and housing. Taxes in Canada have grown much more rapidly than any other single expense for Canadian families. Hence, it is critical to educate yourself on the legal opportunities available to you to reduce your tax bill and maximize your tax savings. That's where tax deductions come in. A tax deduction works by reducing your income that is subject to tax. The savings you get from the tax deduction is equal to your marginal tax rate. Your marginal tax rate is the highest tax rate percentage you ever reach. Now, if you had a $1,000 tax deduction, this is how much tax you would save based upon your marginal tax rate. If your marginal tax rate is 20.5%, you would save $205. If it's 29%, you would save $290. Hence, the higher your marginal tax rate, the higher your savings from the tax deduction. This is considering federal taxes only. When you factor in provincial taxes, the savings from the $1,000 tax deduction is increased even further. Now, what tax deductions are available to you? Let's start off with RRSP contributions. RRSP contributions are one of the most popular tax deductions to reduce your tax bill and at the same time save for your retirement. I recognize that saving for retirement isn't a priority when you're counting the numerous bills to pay at the end of the month. I barely contributed towards my retirement savings in my early working years, unless I absolutely didn't have to. What I failed to realize is that you're missing out on two opportunities. First, you get an immediate tax saving from the RRSP contribution. Second, by starting early, you give your savings time to grow at an accelerated rate through the power of compounding. Even a small contribution every year will grow exponentially over time. A helpful strategy to maximize the tax savings from your RRSP contribution is that you can choose to contribute towards your RRSP now when you're in a lower marginal tax rate and then claim the deduction in future years where you may expect to earn a lot more money. By then, you would be in a higher marginal tax rate and the savings from the tax deduction would be much higher. To understand how RRSPs work, including key deadlines, you can watch my video linked here. A similar related item that often gets missed is RPP contributions. An RPP or registered pension plan is an employer-sponsored retirement plan where your RPP contributions are directly deducted out of your paycheck and typically matched by your employer. If you contribute towards an RPP, you can deduct your employee contributions from your taxable income. Next up, we cover employment expenses. Most salaried employees are not able to claim employment expenses unless your employer explicitly requires you to incur these expenses as part of your job. Any expenses reimbursed to you by your employer cannot be claimed as there's no double dipping. The main employment expense that you could previously claim was the COVID work from home expense. Unfortunately, that has come to an end for the 2023 tax year. For those of you who are self-employed, you can deduct an abundance of expenses as part of running your business, from your phone bill to parking to reduce your taxable income. Next up is accounting and legal fees. If you're looking for some extra tax relief, you may be wondering if the cost of preparing your tax return can reduce your taxable income. For most Canadian taxpayers, unfortunately, the answer is no. The cost of tax prep software and accounting services to help with filing your return is typically only deductible if you're self-employed, earn rental income, or meet certain conditions to qualify as a commissioned employee. However, if the CRA reviews or reassesses your tax return, you can claim accounting or legal fees for assistance to respond to the CRA. Now we move on to childcare expenses. If you're a parent and pay for your children to be looked after, to go to work, school, conduct a business, you may be able to claim a tax deduction for up to $8,000 per child under 7 and $5,000 per child between the ages of 7 to 16. Expenses such as babysitters, nursery schools, daycares, camps, provided their primary goal is to provide childcare, can be used to reduce your taxable income. Unfortunately, the childcare provider cannot be a close family member, so grandma and grandpa don't count. There are limitations on who can claim childcare expenses. In most cases where there are two parents living in the same house, childcare expenses are deducted from the lower income earner, even if that person earns nothing. So if your partner has no income, it may not result in a tax savings for you. A tax deduction often missed out by a lot of people is money paid for union or professional dues. When you're a member of a trade union or association of public servants, you can deduct union dues paid. The CRA lets you claim professional membership dues, such as for your CPA membership if you're an accountant like myself. Any professional or malpractice liability insurance premiums can also be claimed. Again, there's no double dipping. So if your employer reimbursed you for these expenses, you cannot claim it. Next up is rental property expenses. If you own a rental property, expenses relating to your rental property, such as property taxes, repairs, legal fees to prepare leases, plus the interest on the mortgage that supports your rental property can be deducted. If your rental property is in an overall loss-making position, that is, the expenses you incur outweigh the rent you collect, this loss can be used to offset against other sources of income, such as employment or business income. Next up, we cover capital losses. If you sell your investments, such as stocks, ETFs, or even your rental property at a loss, you can offset this loss against taxable capital gains. This is assuming none of these investments are held inside a tax-sheltered account, such as a TFSA or an RRSP. Unfortunately, you cannot offset a capital loss against other sources of income, such as employment or business income. Capital losses can only be offset against capital gains. Capital losses can be carried back 3 years and carried forward indefinitely. It is a good time to organize loss-making investments against profitable investments to minimize your capital gains tax paid. And now we come to a new deduction for 2023. FHSA contributions. The First Home Savings Account, or the FHSA, was introduced in 2023 and is a tax-advantaged way for you to save money to buy your first home. I was excited when the FHSA was first announced, but quite disappointed to discover that I didn't qualify. The FSHA combines the best features of both the RRSP and the TFSA. Identical to an RRSP, contributions made to an FSHA reduce your taxable income. The annual FHSA contribution limit is $8,000 for 2023 and the same for 2024. To accumulate room, you do have to open an FHSA account. Otherwise, you don't accumulate it. Identical to an RRSP contribution, claiming your FSHA contributions generates more savings for you when you're in a higher marginal tax rate. So you may choose to defer claiming the FSHA deduction to future years, where you may expect to earn more money. The last day to make an FSHA contribution is December 31st. And finally, I'll briefly touch on moving expenses. You can only claim moving expenses if you move to be closer to a new work location by at least 40 kilometers. Unfortunately, you cannot claim moving expenses if you're moving homes because perhaps it's a nicer place that meets your needs, which is why I moved and a lot of people tend to move. In my next video, I will cover the most popular tax credits to remember when filing your taxes to reduce your tax bill and maximize your tax savings. Thank you for watching.